Hello, and thank you for watching this video on the methods for tapping home equity for cash in the current high interest rate environment. House prices generally have increased by quite a bit over the past few years, and this provides homeowners with an opportunity to get cash by tapping into the ownership stake in their home. This is also known as home equity. While a cash-out refinance has been a popular way for homeowners to tap into their home equity for cash, the raise in interest rates over the past few years has made the cash-out refinance much more expensive than it has been in the past. This video is going to answer 3 questions. First, how does a cash-out refinance work, and how do we measure the cost? Second, why is a cash-out refinance more expensive today than it has been in the past? And finally, what is an alternative way to turn home equity into cash in the current high interest rate environment? Before we go there, I want to review how a mortgage works. A mortgage is a loan. A homebuyer borrows money from a lender so that they can buy a house today. The homebuyer then pays back the lender in monthly installments, usually over a period of 30 years. The amount that the homebuyer borrows is called the principal amount. That and the interest rate are what determines the size of the monthly payment that the homeowner makes. Here's a stylized example of monthly mortgage payments. You can see the principal payments here in blue and the interest payments in orange. Not shown here are other payments like taxes and homeowners insurance. Because each monthly payment includes at least some principal, the homeowner is paying back a bit of the loan with each monthly payment. Over time, the principal balance on the loan decreases and the homeowner's equity increases, which you can see here in the black line. The homeowner's equity also increases if the value of the home goes up, and conversely decreases if the value of the home decreases as well. As the homeowner's equity increases, so does their wealth, and this creates the opportunity for the homeowner to tap into their home equity for cash. In a cash-out refinance, a homeowner with an existing mortgage takes out a loan from a lender that is for more money than the existing principal of their loan balance. In turn, the homeowner makes monthly installments of principal and interest that are paid back to the lender. The homeowner then uses the new loan to pay off the existing principal balance on the current mortgage, and then the homeowner keeps the difference in cash. That's the cash-out portion of the cash-out refinance. Now, to see an example of what a cash-out refinance looks like and what it will cost, we'll take a look at our cash-out refinance calculator and plug in some values from an example of a monthly mortgage statement. A monthly mortgage statement is usually mailed or emailed to the homeowner monthly, or can be accessed by logging into the mortgage provider's website. Here's an example of what a monthly mortgage statement might look like. I've highlighted the key terms here in red. To calculate what a cash-out refinance might cost, we'll need the terms highlighted here in red. First, we'll need the outstanding principal of the loan. That's how much the homeowner still owes the lender. This here is $230,000. We'll also need the interest rate, 3.5%. Then we'll need the monthly principal and interest payments. Here, $427 per month for principal and $673 per month for interest. Now, let's plug those figures into our cash-out refinance calculator to see what the final cost will be. Here's the calculator. I've highlighted the inputs we need in yellow. On the left side is the information that we've already gone over: the outstanding principal of $230,000, the interest rate of 3.5%, the monthly principal payment of $427, and the monthly interest payment of $673. Another piece of information we'll need, which isn't typically provided on the monthly mortgage statement, is the months since the first mortgage payment. Here, I've assumed 36 months, or 3 years. The right-hand side of the calculator shows what the new monthly payment might look like. I've input here an interest rate of 7%. This fluctuates over time, so it's important to shop for the best interest rate the homeowner can possibly receive. For the amount of cash back, again, this can vary by homeowner, I've assumed here $45,000. Now we're ready to look at what the cash-out refinance might cost. When the refinance is completed, the homeowner will receive a new loan for $286,000. They'll use $230,000 of that loan to pay off the existing principal. That's the outstanding principal on the left of this chart. And just like they did on the original loan, they'll need to pay closing costs. Here, 4% of the loan balance, which is $11,000. They'll then have $45,000 left over, which is the cash out part of the refinance. Now we can see the total cost monthly of the cash out refinance. On the left, we see the original mortgage payment, which was $1,100. On the right, highlighted in red, we can see the new monthly payment, which is $1,903. That's an additional $803 per month, or 70% more each month in the payment. The effective interest rate on that new cash back is over 21%. Why is that? Well, the effective rate is calculated based on the amount added to the monthly payment and the cash back. Additionally, the $11,000 in closing costs also contributes to the effective interest rate. So to review, the new principal and interest payment is an additional $803 or 70% each month for the $45,000 received in the cashback refinance. The 7% interest rate that was seen in the last chart is based on interest rates seen in late 2022 and early 2023. Let's rewind the clock back to 2021 and see what the cost of a cash-out refinance was before the recent rise in interest rates. Here, we have the same information on the left, outstanding principal of $230,000 and an interest rate of 3.5%. On the right, we see a new interest rate, and this, as I mentioned earlier, is a much lower rate of 3.25%. Here, the interest rate actually decreases from the original loan. Now, we take out the same original $45,000 and we pay the same amount in closing costs of $11,000. Highlighted in red is what the cash-out refinance cost would be with a lower interest rate. We can see here that now the new principal and interest payment monthly is $1,245, and the payment increase here is only $145 per month. That leads to an effective interest rate, again, taking into account the new payment and the closing costs, of 1%. The bottom line here is clear. The increase in interest rates has dramatically increased the cost of a cash-out refinance, going from an effective interest rate of 1% at the end of 2021 to an effective interest rate of over 21% in our example using current interest rates. Now that we've covered the expense of a cash-out refinance in the new high interest rate environment, that raises a natural question. Is there an alternative to the cash-out refinance that will provide homeowners with a less expensive way to tap their home equity for cash? The answer to that question is yes. It's the home equity loan. Here's the key difference between a home equity loan and a cash-out refinance. A home equity loan does not touch or change the original mortgage, which stays as it was originally. Instead, the homeowner converts their home equity into cash by taking out a second mortgage known as a home equity loan. There are two other key differences between the home equity loan and the cash-out refinance. First, the principal on the home equity loan is typically only for the exact amount of the cash back that the homeowner wants to receive. Second, the home equity loan is typically taken out for a shorter period of time, say 10 years instead of the mortgage standard 30 years. Let's see how much it will cost to take out that same $45,000 from a home equity loan as opposed to a cash-out refinance. Now, let's take a look at our home equity loan calculator. Notice that on the left-hand side of this chart, we've kept the original terms of the mortgage exactly the same. What we've changed is the right-hand side of the chart, which shows us the terms of the home equity loan. I shopped around for interest rates and I found an interest rate typically of 13.5% at best. Again, it's important here to shop around to see what the best interest rate a homeowner can receive. Here in red, we can see the new cost combining the home equity loan payments with the original mortgage payments. Combined, they cost $1,785 a month. This raises the total payment by $685 monthly, and the effective interest rate on this cashback is 13.5%, exactly the same as the real interest rate on the home equity loan. The reason these two are the same is because the new loan payment only applies to the $45,000 in the new home equity loan and not, as with the cash out refinance, on the rest of the outstanding principal of the original mortgage. In this example, the closing costs are not charged directly and instead are included in the interest rate, 13.5%. And because that interest rate only applies to the new $45,000 in cash out, it may be less than the original closing costs in the cash out refinance. Now, let's compare the cash out refinance and the home equity loan side by side to see the difference in costs. In the cash out refinance, the interest rate was 7%, as compared to the home equity loan, which sees an interest rate of 13.5% on the new $45,000. The total monthly payment then in the cash out refinance is $1,903, and in the home equity loan, adding in the original loan, is $1,785. That means that the home equity loan costs less monthly than the cash out refinance by $118. And it's worth noting that because the home equity loan is shorter, 10 years, it will be paid off if the homeowner stays in the house and continues making payments for those 10 years. In the case of the cash out refinance, that increased monthly payment will have to be paid off for the entire 30 years of the new mortgage, 20 years more than in the home equity loan example. Another item to note here is that the headline interest rate of the home equity loan is higher, 13% compared to 7%, but the effective interest rate is lower. In the case of the home equity loan, it stays exactly the same at 13.5%, but in the cash out refinance, it's effectively 21.4%. The difference in monthly payments accumulates massively over time. Let's say our homeowner plans to stay in the house for another 7 years, waiting for their children to graduate from school. That homeowner will save $49,000 in interest payments over the 7 years by taking advantage of the home equity loan. Those savings are translated almost directly into the actual equity the homeowner has in their house. Over that same 7-year period, the homeowner would have an additional $50,000 in home equity, assuming that the value of the home stays constant. As we've hinted at earlier, the advantage in savings that a homeowner can derive from choosing a home equity loan is a direct result of the increase in interest rates over the past year or so. If we rewind the clock back to 2021 again, we see a very different picture when comparing the cash out refinance to the home equity loan and the original mortgage. In this chart, we've kept the right-hand side with the original loan and the home equity loan exactly the same as it was in the previous chart. But we've updated the cash out refinance to take advantage of 2021's lower interest rates, again 3.25% here. This results in an additional monthly payment for the cash out refinance of $145 and an effective interest rate of 1%. Compare again to the home equity loan's payment increase of $685 and the effective interest rate of 13.5%, which again is the same as the headline interest rate. Here, the comparison is more mixed. In this case, with the lower interest rate on the cash out refinance, the homeowner will save about $25,000 over time as a result of taking out the cash out refinance. However, recall that the cash out refinance replaces the original loan. This means that if the homeowner sells in 7 years, the homeowner will owe an extra $32,000 on the cash out refinance compared to the home equity loan. To put it another way, if the homeowner were to take out a home equity loan, even in this lower interest rate environment, the homeowner would have accumulated another $32,000 in equity as a result of paying off more of their original loan's balance under the home equity loan scenario. Given that home equity loans are a much more cost-effective alternative, it's worth asking why some homeowners still take a cash-out refinance at all. Well, for one thing, lenders aren't always willing to offer a home equity loan to every homeowner who applies. Homeowners will usually need a higher credit score and income in order to be approved for a home equity loan. Home equity loans can also have stricter limits on the amount that a homeowner can borrow. Regardless, given how much better the home equity loan is as an alternative, homeowners who are looking to convert their home equity into cash should always check to see if a home equity loan is available before pursuing other cash-out options. You can start by checking your monthly mortgage statement to see what the interest rate is on your existing loan. And when looking for a cash-out option, make sure to shop around. Thank you for watching this video, and good luck.